Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Arcady Sosinov, founder and CEO of Freewire Tech. We're going to discuss EV adoption and the charging stations that are required to make all these EVs happen on the road. It is great to have you with us. Welcome to TradeTalks.
Thanks for having me.
And we see EV adoption certainly continuing to the upside. We know what that trajectory looks like, but charging infrastructure in the US and Canada in particular lags behind. What makes Freewire's Boost Charger different, and how are you accelerating the energy transition?
It's clear that consumers have recognized that EV is a better product overall, except for one facet, and that's the charging infrastructure. The fact is it's not available, it's not reliable on the market today. And no matter how you slice it, when you dive into the numbers, the reason that it's not available is because of utility infrastructure. The fact is charging requires very high power that's typically not available on commercial and retail sites. So you're looking at utilities to upgrade their existing aging grid infrastructure and bring new power to these locations. And that's typically a 24 to 48 month process and costs hundreds of thousands to millions of dollars. And most retailers are not willing to bear those costs. So we've developed a technology solution that pairs battery storage plus charging. We effectively disintermediate the utility from the equation and allow retailers to install high-power, ultra-fast charging using existing low-power infrastructure, leveraging that battery as a buffer solution.
So we're hearing about new EV makes and models are being announced, it seems like every day. What investments are you making in technology and in R&D to stay ahead of the charging curve, so to speak? And how is the market evolving for ultra-fast charging?
Well, the market has reached a little bit of a plateau. We see now that vehicles can charge in 15 or 20 minutes, but you're never going to see vehicles charge in as little as 1 or 2 minutes, the way that you would fuel your combustion vehicle. The way to counterbalance that is to make charging ubiquitous, to have charging infrastructure available both at your home as well as in all retail locations. That includes convenience stores, quick service restaurants, big box stores, and so forth. That's the way that you make charging infrastructure seamless and the charging experience seamless for consumers. Again, it goes back to the original point I made, which is that it's almost impossible to get power to these locations. And as our utility infrastructure ages, the cost of bringing that power out becomes more prohibitive and more expensive. So what we're focused on is making that experience ubiquitous. The fact is we're selling to retailers such as BP and Phillips 66 and Chevron, there are thousands of these locations across the country, and if everywhere you go you have availability of charging, then that 15 to 20 minute experience doesn't feel so bad.
Well, it's interesting because your key customers are in the traditional oil and gas business. You had mentioned Chevron, BP, Phillips 66, Parkland in Canada, to name a few. How does it help to drive their legacy business?
Ultimately, the business of the retailer is not to sell electrons or not even to sell hydrocarbons. It's actually interesting to me that consumers still think that gas stations make money on gas. Frankly speaking, they make money inside the convenience store on coffee and candy bars and Coca-Cola. And so these retailers want to continue that legacy business. They want to drive foot traffic from the parking lot into the store to buy goods and services. And enabling charging on those sites, it means that these consumers can stop by for 15 minutes, walk into the store, buy a Coca-Cola and a candy bar, and walk out. And that's why these retailers are the perfect owners and operators of charging infrastructure. They're used to operating a low gross margin business around fuels. They will likely continue to operate a low gross margin business around electrons or servicing electric vehicles, but then ultimately the business is inside that store. So what we enable is we deploy the charging infrastructure on the site very quickly at a lower cost, but then we tie the systems of charging with the existing retail systems, payments, loyalty programs, and we try to entice that consumer to walk from that charger into the store and convert some of that share of wallet to, again, Coca-Colas and candy bars.
Who's your biggest competitor, and how has the competitive climate evolved since you founded the company 9 years ago?
When you dive down into the core technology around battery storage and integration of battery storage with charging, there are no commercially scaled competitors in the US. There certainly are some in Europe, but not in the US quite yet. Really, when you look at the dollars that the retailers are spending to deploy charging, our main competitor, frankly speaking, is a car wash. These retailers would love nothing more to install another car wash because they know those cash flows, they know the business, and they know what kind of retail foot traffic that's going to drive inside the store. We need to walk in and convince them that the business of charging is a business that they can operate, meaning that we can install, we can service these systems, and that the consumers can then convert and walk into the store. So ultimately, that's our competitor for the dollars being spent by the retailer. But broadly speaking, even zooming out a little bit further, the competitor is frankly still the utility. These utilities want to install infrastructure on the ground because that's how they make a rate of return, but they can't do so fast enough, and I'm not willing to put my success and my company's success in the hands of the utility. And when you look at the market as a whole, they haven't been successful in the past in deploying enough infrastructure to support ubiquitous charging. That's why we don't see charging stations available today.
Are these chargers, are they universal? Can you use them from model to model?
You can. We do have some standards war these days, and you probably saw the news related to Tesla and Ford and General Motors. Ultimately, that's a decision around the plug, but our charging infrastructure, as well as most charging infrastructure, is compatible with all vehicles, meaning it has multiple plugs. The adding of multiple plugs on the system does raise costs, and ultimately those costs are borne by the consumer in some ways. But long story short, if you have multiple plug availabilities, any vehicle can plug into the charger.
And it's not just passenger vehicles. FreeWire, one of your fastest growing segments is providing to freight and fleet markets. How do these applications differ from consumer vehicles, and what challenges does that present?
You know, even I've been surprised at how fast the freight and fleet market has grown, especially in the Class 8 electric trucks. You see these large semis with the introduction of the Tesla Semi, but also with Volvo, Navistar, International, some of these large brands. They have introduced their electric trucks, and the buyers, the fleets, are desperately looking for charging infrastructure. They're typically located in fleet facilities or yards that are leased spaces, not owned, meaning that they don't want to bear the cost of installing high-power utility infrastructure on those sites. And they're in locations where that utility infrastructure is typically not available, in large fleet yards, in the kind of suburban locations. So these customers need a couple of different things. One, they need charging infrastructure for those fleet yards, and we can install very quickly. The vehicles are getting delivered today, but when it takes the utility 2 years to bring power to the site, you simply can't wait to get those cars on the road. The second piece is we install that charging infrastructure en route, and this is what's called opportunity charging. If you have a truck that is capable of typically today doing 2 to 3 round trips a day, then you buy the electric version of that truck, but it's only capable of doing 1 to 2 round trips per day, then you need charging en route so that you can replicate the experience of the combustion truck. And so we're installing these charging stations at distribution warehouses, at grocery stores when the vehicles unload their trailer, and in those locations, you simply can't get power. And so our system is the only solution, and why we've seen a lot of growth in that heavy-duty segment.
So what's your relationship like with the utilities, and how are they responding to a large public network of distributed battery assets?
Yeah, there's certainly a little bit of love and hate. I think there's part of the utilities, which remember are not one singular entity. There are a lot of different groups within the utilities that want different things. And there are groups within the utility that would love nothing more to spend the next 50 years building out and upgrading aging grid infrastructure to the tune of, the estimates are about $23–24 trillion by 2050. We don't think that's possible, and we don't think that's going to happen. We think that the rise of renewable generation and renewable energy storage and distributed energy storage is really what's going to take us to the next level of power consumption in the country. And so there are parts of the utility that see that we're deploying batteries at scale and know they can leverage those batteries to frankly lower their own costs. Because if they know that the batteries can smooth out demand on the utility, they can shut down peaker plants and provide lower cost of electricity to consumers. That's ultimately what we're trying to achieve at scale, is a large distributed network of batteries that we can use to flatten the demand curve, which is ultimately good for the utility, and some of them are starting to recognize that.
And you've raised $250 million in private capital over the past 9 years. What's next for FreeWire?
Well, 2023 this year is going to be a seminal year for us. It's when we achieve over 9 figures in revenue. And just so you get a sense of where the market sits today, no one's doing 10 figures, so no one's doing $1 billion plus. So it's a pretty nascent market, and that type of revenue puts us in the top 4 or 5 players globally for pure play DC fast charging infrastructure. So, but ultimately, we're not doing it at growth at all costs. That's not the market anymore. Now we're working on sustainable growth, meaning we are looking to work with our suppliers, expand those supply relationships to lower our costs so that we can achieve those supernormal gross margins on the technology that we sell, and grow a little bit slower than we otherwise would have in prior markets,
right,
but ultimately make it more sustainable for our investors.
Well, I mean, it makes you wonder when you think about the private market in general. This valuation reset that we saw has taught lessons, just to your point, where it's not growth at all costs. It taught you a lot about your balance sheet and how you manage the business. And I think this is a good lesson to be learned for a number of private companies who perhaps have never experienced this type of environment that we're in right now.
And for private companies that I think did not take the SPAC bait a couple of years ago. And you probably see a lot of broken de-SPAC names in public markets. And it's unfortunate because then it becomes very difficult to raise additional capital to fully fund the business plan. I think companies that decided to wait a little bit longer and focus on their balance sheets are going to end up being the winners in the space. So I'm very excited about the growth stage private segment of our market and our industry, because I think there are a lot of really smart names that are great companies that are going to come out over the next few years as having been a little bit more mature, having focused on both top line revenue but also growth at the bottom line, and will ultimately be the winners.
Yeah. All right, Arcady, we appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.